Most people think investing mistakes happen in big dramatic moments, the kind you see on the news. A market crash, a bad stock pick, a sudden loss that wipes out years of savings overnight. But that's almost never how wealth is lost. The real damage usually happens quietly, slowly, in ways that don't feel dangerous at the time. And that's exactly why so many hardworking people reach their 40s or 50s and look back with a strange feeling, not panic, not even regret, just confusion. They wonder how they worked for decades, earned steady paychecks, tried to do the right things, and still ended up years behind where they thought they would be. Money can be recovered, losses can be rebuilt, markets rise again. But time doesn't come back. And the truth is, most investing mistakes don't just cost money, they cost years. 5 years, sometimes 10. In some cases, even more. What makes this especially dangerous is that these mistakes rarely look like mistakes when you're making them. They feel reasonable. Responsible even. They feel like caution, patience, waiting for the right moment. And yet, hidden inside those decisions is something most people never see until it's too late, a slow leak of time that quietly weakens the power of compounding year after year. Because here's the thing, the biggest investing mistake isn't always losing money. Sometimes it's losing momentum. If you care about protecting your future and not just chasing returns, take a moment to like this video, subscribe to the channel, and share it with someone who works hard but wants their money to work harder. And before we go further, I'd like to ask you something simple. At what age did you make your very first real investment? Even if it was small, type that number in the comments. You might be surprised how many people share the same starting point as you. When people talk about investing mistakes, they usually imagine something dramatic, a terrible stock pick, a market crash, or some reckless gamble that went wrong. But in my experience, the mistakes that cost the most aren't loud, they're quiet. They happen in small decisions. Decisions that feel harmless at the time. Let me tell you what I mean. Imagine a small faucet dripping in the corner of a house. Just one drop at a time. If you walk past it once, you probably wouldn't think much of it. Even after a day, the damage would be invisible. But leave that drip alone for months, years, and eventually the damage shows up. Wood begins to warp, mold forms. Repairs become expensive. Investing mistakes often work the same way. Not explosive, but persistent. And one of the most important ideas to understand early in your investing life is what I like to call the time leak rule. The time leak rule is simple. Small investing mistakes rarely destroy wealth overnight, but they quietly steal years from your future. Years that compounding could have been working for you. Years that never come back. Now, here's where this becomes personal. Most people don't realize they're losing time because nothing feels wrong in the moment. They feel responsible, careful, patient. And those are good qualities, but in investing, patience has to be paired with action, not hesitation. Let me give you a very common example. A person decides they want to start investing. They open an account. Maybe they even deposit a little money. But then they pause. They start reading headlines, watching markets move, waiting for things to feel safe, waiting for the right moment. A week passes, then a month, then another. They don't feel like they're making a mistake because technically they haven't lost money. Their balance hasn't dropped. There's no visible damage. But something important is happening behind the scenes. Time is slipping by without being used. And that's the part most people miss. Because investing isn't just about money sitting somewhere. It's about time working alongside that money. Without time, even good investments struggle to grow. With time, even average investments can become powerful. Let me ask you something here and answer this honestly in your own mind. Have you ever paused investing because the market felt uncertain, even when you had money ready? Not because you were reckless, but because you wanted to be careful. That feeling, that pause, is where many years quietly disappear. You see, wealth doesn't usually fail because someone made one terrible decision. It fades because of hesitation, delay, and small interruptions that seem harmless at the time. A skipped contribution here, a delayed start there. A moment of waiting that stretches longer than expected. And the strange thing is, when you're inside those moments, they feel smart, responsible, thoughtful. But over time, those small pauses begin to stack on top of each other. Weeks become months, months become years, and eventually people look back and realize something uncomfortable. They didn't lose money, they lost time. That realization often shows up much later than expected. Sometimes in your late 30s, sometimes in your 40s, occasionally even later. It shows up when people finally look at their accounts and wonder why the numbers aren't growing as fast as they hoped. And that's usually the moment when they begin asking a different question, not, what stock should I buy? But something deeper, something more important. They start asking, what have I been doing that slowed my progress without me realizing it? And as we keep moving forward, one particular habit begins to stand out more than the others, a habit that feels intelligent while you're doing it, but quietly delays progress year after year, a habit so common that millions of investors believe it's actually the responsible thing to do, even though it costs them more time than almost anything else they could be doing. Well, a habit so common that millions of investors believe it's actually the responsible thing to do, even though it costs them more time than almost anything else they could be doing. That habit is waiting for the perfect moment to invest. Now, on the surface, that sounds reasonable. In fact, most people feel proud of this instinct. They tell themselves they're being cautious. They want to avoid buying at the wrong time. They want prices to fall first. They want certainty before committing their money. And emotionally, that makes sense. Nobody enjoys the feeling of investing money only to watch the market dip a few days later. That small drop can feel like proof that you made a mistake even when you didn't. But here's the quiet truth that many experienced investors eventually discover. The market rarely offers clear signals that now is the perfect time. More often, it moves when people least expect it and hesitates when people feel confident. And this leads us into something I often call the participation rule. The participation rule is simple. Wealth is built by staying invested, not by waiting to feel comfortable. You see, markets don't reward hesitation. They reward presence. The investors who benefit the most over time aren't the ones who predicted every move correctly. They're the ones who showed up consistently and allowed time to do its work. Let me give you a picture that might feel familiar. Imagine standing on a train platform. Trains pass regularly, each one capable of taking you toward your destination. But instead of boarding one, you decide to wait for the perfect train, one that arrives at exactly the right time with exactly the right conditions. So you wait. Another train passes. You hesitate again. Then another. And before long, hours have passed even though you were surrounded by opportunities the entire time. Investing works much the same way. The people who wait for perfect conditions often spend years standing still while others move forward slowly but steadily. Not because those others are smarter, but because they understood something important. Early movement matters more than perfection. And here's where the real cost shows up, though it doesn't always appear immediately. There are certain days in the market, just a handful, where growth happens quickly. Nobody rings a bell before those days arrive. Nobody sends a warning message. They simply happen, and investors who are waiting on the sidelines during those moments don't just miss gains, they miss momentum. Missing momentum is expensive in a way that's hard to see in the short term. Because let's say someone delays investing for 6 months, waiting for the market to feel safer. Maybe prices don't fall. Maybe they rise instead. Now that investor faces a difficult decision, invest at a higher price or keep waiting and hope for a drop. Many choose to wait again, not because they're careless, but because they're trying to be careful. Irony of it. Carefulness, when taken too far, becomes hesitation. And hesitation, repeated over years, turns into lost time, the most valuable resource in investing. Let me ask you something here and think about it honestly. How many times have you told yourself, I'll start investing when things settle down, when the news looks better, when the economy feels safer, when the market becomes predictable? The problem is markets are rarely calm when they're offering the best long-term opportunities. In fact, uncertainty is often present right before growth begins. And the investors who accept that uncertainty not blindly, but patiently, are usually the ones who benefit the most. Now, none of this means you should invest recklessly or ignore risk. That's not the message here. Responsible investing still matters. Thoughtful planning still matters. But waiting for certainty, that's where the hidden danger lies. Because the real enemy isn't a market drop. It's standing still while time keeps moving. And what makes this even more important is that timing mistakes don't just delay growth. They weaken something much bigger, something that sits at the very heart of long-term wealth building. Something so powerful that even small delays can shrink its effect dramatically over time. And that brings us into the second mistake, which quietly slows progress more than almost anything else an investor can do, even when they believe they still have plenty of time left. And that's something at the heart of long-term wealth building is compounding, a force so simple in theory, yet so powerful in practice that small delays can quietly reshape an entire financial future. You see, most people understand compounding in a basic way. They've heard the phrase before, they know that money grows over time. But what many don't fully feel, not until much later, is how sensitive compounding is to time itself. Not just years invested, but years missed. Let me give you a picture that makes this clearer. Imagine two individuals, both hardworking, both responsible, both earning similar incomes. The first begins investing at age 25. Nothing dramatic, just steady, modest contributions month after month. The second waits until 35. Not because they were lazy, but because life was busy. Bills came first, responsibilities piled up, and investing always felt like something that could be started a little later. At first, their paths don't look very different. In fact, by age 35, the second person may feel confident. They finally begin investing, perhaps even contributing more aggressively than the first person did early on. It feels like catching up should be possible. But here's where compounding reveals its quiet strength. The first investor didn't just add money, they added time. 10 extra years of growth, 10 extra years of reinvested earnings, 10 extra years where small gains stacked on top of each other, slowly building momentum that becomes harder to match later. And this leads us into what I often call the compounding delay rule. The compounding delay rule is simple. The greatest cost in investing is not losing money, it's delaying growth. Because when growth is delayed, the snowball starts rolling later. And when the snowball starts late, it doesn't matter how hard you push later, the hill is shorter. Now, here's the part many people overlook. Delays rarely feel permanent when they're happening. A year feels like nothing. 5 years feels manageable. People tell themselves they'll make it up later when income increases, when life stabilizes, when things feel more comfortable. But compounding doesn't negotiate with intentions. It only responds to time. And what makes this even more important is that compounding isn't just affected by when you start. It's also shaped by how consistently you continue, because there's another behavior quieter than timing, subtler than delay, that interrupts compounding in ways many investors don't notice until the damage has already stretched across years they can't recover. Until the damage has already stretched across years they can't recover. And that quieter behavior, the one that interrupts compounding more subtly than timing mistakes or delayed starts, is reacting emotionally to short-term market movements. Not because people are reckless, but because they're human. You see, markets move. That's their nature. Prices rise, prices fall, headlines appear, and uncertainty shows up at the worst possible moments. None of this is unusual. In fact, it's completely normal. But what turns normal market movement into long-term financial damage is not the movement itself, it's how investors respond to it. This is where something called the behavior gap quietly begins to take shape. The behavior gap is the difference between what investments are capable of earning and what investors actually receive simply because of their reactions. Let me explain that in a way that feels practical. Imagine owning a well-built ship. Strong structure, reliable engine designed to handle rough seas. Now imagine sailing that ship into a storm. The waves grow tall, the wind becomes loud, the sky turns gray. None of that means the ship is failing. It simply means you're traveling through weather. But if the captain panics, if he abandons the controls, if he jumps overboard at the first sign of trouble, that's when disaster happens. Not because the ship was weak, because the reaction was. Investing works the same way. Many people begin their investing journey with good intentions. They select reasonable investments. They create a plan. They contribute regularly. And for a while, everything feels steady. Growth appears slow but reassuring. Confidence builds quietly. Then the market drops. Not permanently, just temporarily. Maybe 10%, maybe 20%. Headlines become louder. News channels begin speaking with urgency. Words like crash, recession, and uncertainty appear everywhere. And suddenly, doubt enters the room. People start checking their accounts more often. Daily, sometimes hourly. They watch numbers fluctuate and begin to feel something deeper than concern. They feel fear. Not because they fully understand what's happening, but because uncertainty feels uncomfortable. So they make what feels like a protective decision. They sell, not because they plan to, but because they want the discomfort to stop. And here's the quiet tragedy in that moment. Selling during fear doesn't just lock in losses. It interrupts compounding. It breaks momentum. It removes time from the equation in ways that are difficult to recover later. Now, to be fair, emotional reactions don't only happen during downturns. They also happen during excitement. Markets rise quickly. Prices surge. News becomes optimistic. People hear stories of fast gains and begin to feel something else, not fear this time, but urgency, a fear of missing out. So they buy often at higher prices, chasing momentum instead of following discipline. And once again, compounding is interrupted, not because of poor investments, because of shifting emotions. This pattern, selling during fear and buying during excitement, is far more common than most people realize. And over time, it slowly widens the gap between what markets return and what investors actually keep. Let me ask you something here and answer it quietly in your own mind. Have you ever looked at your investments during a market drop and felt the urge to stop everything just to feel safe again? Not because your plan changed, not because your long-term goals disappeared, but because the short-term discomfort felt overwhelming. That moment, that internal pressure, is where many years of progress quietly begin to unravel. And what makes this especially important is that emotional decisions rarely feel emotional while they're happening. They feel logical, protective, responsible. People convince themselves they're avoiding risk when in reality they're stepping away from recovery because markets historically have recovered from downturns. But investors who leave at the wrong moment often struggle to return at the right one. They wait, they watch, they hesitate again. And just like before, time continues moving forward without them, which leads to a realization that slowly settles in after years of these repeated interruptions. Wealth isn't usually destroyed by a single dramatic mistake. It's worn down by patterns, repeated quietly until people begin wondering whether there's a way to rebuild lost momentum and regain control of the time that once slipped through their hands. Oh, until people begin wondering whether there's a way to rebuild lost momentum and regain control of the time that once slipped through their hands. And the honest answer is yes, momentum can be rebuilt. Not instantly, not dramatically, but steadily. In the same quiet way mistakes happen, progress can also happen one consistent step at a time. Because here's something many investors don't fully appreciate until later. You don't need perfect decisions to build wealth. You need repeatable ones, simple ones. Decisions you can make again and again without second guessing yourself every time headlines change. That usually starts with removing decision making from moments of emotion. Instead of asking yourself every month whether now is the right time to invest, you create a system that invests automatically regardless of mood, regardless of news, regardless of short-term noise. Think of it like steering a large ship. When a ship changes direction, it doesn't spin sharply, it turns slowly, gradually, almost invisibly at first. But given enough time, even a small adjustment leads to a completely different destination. Investing discipline works the same way. If someone has delayed starting, they don't need to panic, they need to begin. If someone has paused during uncertainty, they don't need to regret, they need to resume. If someone has reacted emotionally in the past, they don't need to feel shame, they need to build structure. Because structure protects you from yourself. And one of the simplest forms of structure is consistency, setting aside a fixed amount at regular intervals and allowing time to take over from there. Not chasing headlines, not predicting the next downturn, not reacting to every market movement, just continuing month after month. Year after year, what's interesting is that once this rhythm begins, something subtle changes inside the investor. The market becomes less frightening. Short-term drops feel less personal. Growth begins to feel less mysterious. Not because uncertainty disappears, but because discipline creates stability where emotion once dominated. And over time, the focus shifts away from reacting and toward building, toward strengthening habits that allow compounding to work uninterrupted, toward protecting time instead of chasing timing. Because in the end, the investors who move forward most confidently aren't the ones who avoided every mistake. They're the ones who built systems strong enough to survive them, systems that quietly carry progress forward even during uncertain seasons. And that realization often leads to a deeper question about what truly separates those who steadily build wealth from those who struggle for years, despite earning good incomes and working just as hard.